the financials were the most powerful group in the market based on the expectation of higher rates, and in particular the Fed increasing rates in March, which they did do, but they did what's called a dovish increase, meaning that they increased rates, but they didn't go and say, rah, 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 we're going to go and increase rates at an even faster pace. And people were maybe looking for that given the strength of the economic numbers that we've been seeing. So after the Fed increased rates, ironically, which is what everybody had been looking for, the market then started to back and fill. Our portfolio actually has performed pretty well in the first quarter. We're basically in line with the market, even though the market was up 7% as of yesterday. And that's actually pretty tough for us. Usually when you have that much of an increase in the market, we're going to lag because we're low risk, we're low beta, and that puts pressure on our returns. So our stock picking has been good. We are pretty defensively positioned, as we always are. When the market has taken on the chin in the last couple of years, we have been very defensive, actually declining only about 75% of what the market's declined. And since we haven't really changed our positioning very much, we would anticipate, should the market get messy, that we're going to continue to protect your money. So the best sectors in the quarter were, for the portfolio, were materials and consumer discretionary. In the materials sector, it was helped by PPG, which is a long-held position. And PPG is a very large paint company, and they're rumored to be acquiring Axo. They have a war chest, and people have been kind of itchy about them using it. The other stocks that have helped us in the retail sector, we had very good selection. So we had big positions in Home Depot and TJX. They both had excellent quarters. They're two of the few retailers that are not hurt by Amazon. So that's helped us. And then finally Comcast, which is our biggest position, has been a very strong performer, and they're just clicking along. They're doing very well with growth in broadband, and they're also helped by deregulation by the Trump administration. The key areas that hurt us in the first quarter, and I don't want to overemphasize this because the actual numbers are very small, were the insurance sector. There were a couple of industrial names that had squishy quarters, GE and UPS, that were down a little bit, but the magnitude of the numbers that we're talking about are very, very small. I would say that the economy is very strong. The numbers, there was an extraordinary report that mentioned that every economic number that came out was at the high for the cycle, which is quite an extraordinary thing. And I don't really see anything changing about that. If interest rates continue to rise, that likely keeps on driving stocks because the bond market is so large, and interest rates, even though they've risen, are still so low, the interest rates can rise an awful lot more, and so there can be a ton of money that can flow out of the bond market and into the stock market and make it continue to rise. But I think for 2017, we're likely to have a pretty good market. It probably won't increase at the rate that it did in the first quarter, which was, again, rather extraordinary, especially based on the point where we are in the business cycle. But I think we could have some bumpies right now, but my guess is it's going to be a good year.